another segment of the yield curve, Treasury yield curve inverting. How much, I guess, attention are you paying this as an indicator? And are you concerned that we start seeing signs of stress across equity markets and not just bond markets?
It's definitely one of the indicators that I look at, and it has been a good predictor in the past, or at least an indicator in the past, that a recession is coming. But I don't think that really tells you anything new. We knew that we were a late cycle, and typically the yield curve inverts, and then it takes anywhere from 18 to 24 months to actually move into a recession. So even looking at the yield curve inversion today, we're still looking quite a ways out until potentially we're going to enter into a recession. What I think is probably more critical is really looking at why the yield curve is inverting and some of the peculiarities around this yield curve inversion versus prior periods. And I think there's reasons to believe that this time around, yield curve inversion may not be as good of an indicator as it has been in the past, particularly given the enormous amount of quantitative easing undertaken by global central banks.
So in this sort of environment, before we get to a situation where inflation peaks, or potentially as we continue to have these stagflationary risks flashing, what are your preferred allocations at this point?
I still think that you can invest within equities and invest within pockets of the risk market, but moving up in quality is incredibly important, particularly as you move late cycle. You don't want to be in the high flying, no visibility for earnings growth, sort of companies. You want to be in companies that have high free cash flow generation, that have solid balance sheets, and that are able to withstand, periods of economic weakness. Also, on top of that, given where we are in terms of the rate cycle, given where inflation is, I do think it makes sense to layer in commodity hedges or commodity exposure into your portfolio, whether that's through equities by owning materials and mining companies or energy companies, or through FX by owning, commodity-oriented FX.
On those quality companies, we had heard earlier from Bank of America that they liked U.S. large caps, given their earnings outlook, corporate outlooks. What do you think?
I think that's absolutely right. I think that's the best place to be right now. I like owning U.S. large over all other, regions. I think that small cap will continue to be disadvantaged because of cost pressures, and large caps generally have better balance sheets and are able to withstand higher costs, which is, one of the biggest things afflicting markets right now, and particularly corporates.
When you say commodities exposure, can you also count, say, emerging market currencies that export a lot of commodities?
Yeah, I think that there are certain EM currencies that are export oriented that are, close to the end of the rate hiking cycle and offer good value here. And on the sort of flip side to that, I think EM importers on the FX side would be currencies that I'd be looking to trade against the large commodity exporters.